Good afternoon, everyone. I'm Pamela Hastings, and we welcome you so warmly to another Barometer Readings webcast. It's Tuesday, May 21st, and it looks like the market has slowed down a bit. It's much nicer out there outside, and if you talk to David Burrows, he'll tell you that the market's looking much better as well. There's been a lot of action in the commodity space lately, and Dave will be touching on that sector. As always, if you have any questions, please feel free to send us those questions on the Q&A or the chat via Zoom. And without further ado, I turn the conversation over to the one and only David Burrows, who will provide us with a brief macro overview. Good afternoon, David. I hope you
Hey,
had a
Pamela, how are
wonderful
you?
long weekend. Great.
Thanks for hosting today, and nice to see your sunny smile. I want to thank everybody for joining us today. Lots to talk about. A month of April, we saw about a 5% pullback, which is not atypical. We tend to have, April, yeah. We tend to have 2 to 3, 5% pullbacks over the course of the year, each year. But more importantly, May has recouped all of that, gone on to make higher highs. And under the surface, lots of interesting things going on. Some of them in parts of the market that are not well owned. And I think it's really important to kind of touch on those because there's meaning in everything, and we have to be open-minded about what the future can hold. I know there's some, broadly held views on certain sectors that are going through big changes. But let's work our way to that. So our basic belief is that in equities, we started an equity bull market in 2013 in the U.S. U.S. was the leading market, first one to make a new high from the highs in 2000. Markets worked its way higher in fits and starts. There have been some corrections along the way. Some of them, a little hair raising, like the 2020 sell-off going into COVID in 2022. But nothing like what we see in a secular bear market. Secular bear market, you get, 45 or 55% drawdowns like we did in the financial crisis, or like we did, after the beginning of the Great Depression, or like we saw in 1973, 74. Ultimately, valuations just get too high and really have to correct. When we look at the last two structural bull markets, the 80s and 90s, and 2013 to the present, we see that each of the major pullbacks, either in time or in price, corrected in between 2 and 3 year runs. Generally was that the rising 200-week moving average was the lower bound, which was exactly the case in October of 2022. And here we are now making, new highs. S&P's up 5.45% as of about 3 o'clock this afternoon for the month of May. And that's after about a 5% pullback in the month of April. So we like to look underneath the surface at what is happening, what's good, what's bad. Importantly, correlations, the degree to which stocks behave the same, has been very low, which means that things are being evaluated at the company level or at the sector level. There's no big, broad macro factors that are having an outsized impact, which is when we see a lot of risk. When we look at the market from the October 22 lows, we've seen a series of higher lows and higher highs. We saw a short turn down in our breadth indicators at the beginning of April. And if just a few weeks later, things turned back higher, and we've been working our way higher since then. So as most people know, we have a view as to what may be happening in the market, but if market breadth is not supportive, we don't put on any new positions. It doesn't mean we go sell everything. We use stop losses on our positions. If we get stopped out of a few positions on weakness, it means our cash position builds. But as it sits right now, we're pretty fully invested. Now, outside of the US, we've talked all year about the fact that there's a bunch of global markets that have come out of very long bear markets, and there's no market more apt to talk about in this vein than the Japanese market. 30 years of disinflation or deflation resolved, and markets are working their way higher with the first signs of inflation they've seen, going back to 1991. And this has been a world leader over the last 12 months. Markets up, over 40% from March of 2023. We've seen very strong performance in India, We've even seen strong performance in the Eurozone, and we know there's a lot of antiquated companies, but there's actually a lot of really strong industrial companies and financials. And in fact, those sectors have been quite strong. We know that there's been strength in South America, big run up recently in Argentina. And we've seen strength, shock of shocks in the Canadian market. Now, if you read the paper, there's a lot of reasons why Canada shouldn't be doing very well. Our prime minister, not particularly well liked and unlikely to get reelected. A lot of spending. But there are companies in Canada that sell into the global economy that may be in the sweet spot. In fact, the TSX is behaving remarkably well this year, having taken out highs in 2021 that go back to 2008. So equities around the world looking pretty good. We're going to delve into that further. From a yield perspective, we saw falling yields from 1981 to 2020, where we saw a generational low, and then we saw a reversal. And we've had a very significant series of higher lows and higher highs in yields. And that means that bond prices have been very unfriendly. So what has typically been seen as a low risk investment is now 4 years into a bear market, no sign of resolving. All of the moving averages continue to move lower. The TLT, which is the long end of the US bond market, is down about 50% from the highs. And so we're in a bond bear market. So that poses a problem because people have seen bonds as a ballast in portfolios. The common 60-40 portfolio, 60% stocks and 40% bonds. And the view was if stocks went down, well, bonds would rally. Well, that didn't happen in 2022's bear market. They both went down 20%. And interestingly, bonds are now actually the long end, a little more volatile than gold, which has taken a bit of a safe haven status. So when we look at stocks versus bonds, since the bottom in rates in 2020, stocks are clearly outperforming the aggregate bond index. I would say investors are looking for assets that can help offset the impact of inflation. Corporations have the ability to raise price. And if you buy companies with a rising stream of cash flow, they can pay a rising stream of dividends. That helps offset a rising cost of living. That's what I learned in 1986 when I got into this business. You own companies to help offset the impact of inflation. And of course, that's really important to all of our clients. Now, we've talked about this a fair bit over the last year, 2 years, 3 years, that we have been seeing a reversal in a long-term structural bear market in commodity prices. Now, it makes sense that commodity prices were falling during a period of disinflation. And through this period, companies really didn't invest a lot in capital spending because, of course, prices kept moving lower. It's very unpredictable. But we saw a first leg up in prices going into the global tightening cycle. And we've highlighted that we think we've started the second leg of a long-term bull market prices. So the question is, what does this mean? I get asked, materials is 2.48% of the S&P 500. Why do we care? Well, part of it is because commodities at times have become very large parts of the S&P. Energy has been as high as 20% of the S&P in the past, generally after long bull markets. So if you can buy an asset when it's unloved and it's a very small part of the index and nobody cares, over the course of time, if it becomes a bigger part of the index, it can have a material impact on the portfolios. So the question is, what is the scenario? What is it that could happen? I'm a big believer in understanding market history, not because things repeat, but it's important to understand what can happen. If we compare the commodities index, US commodities index to the aggregate bond index, very clearly 2020 was a watershed. And since then, steadily outperforming. So this may be a different kind of hedge than bonds, maybe a hedge against inflation. And I think inflation appears to be sticky. If we look at commodities relative to the equally weighted S&P, well, of course, they really underperformed from about 2011 through 2022, but that started to shift We went through the tightening cycle and they lifted above this resistance line. And as they often do, when you get a downward sloping resistance line, you come back and test it from the top. And now over the last 3 months, we've turned higher. So the question is, do we have a period coming in front of us where commodities not only outperform bonds, but they outperform stocks? And again, it's a small part of most portfolios, but it could be meaningful. So I kind of wanted to look at what have we seen historically? What could happen if we are into a long-term structural reversal in commodity prices? Well, we've talked a lot about copper over the last couple of years. And, you know, we made a big deal about the fact that in 2023, we got up and out of this consolidation range we were in. And then we've just marched higher week by week since then. So copper prices are up about 33%. We've gone from about $3.80 to $5 a pound. And if we look at that, you say, okay, well, things have moved up. And in fact, I've even heard a few analysts say, well, copper's moved up a lot. Maybe you should take profits. So what does it mean to go through a bull market? Well, this is the long bear market that we've been through 2011 through 2021. Let's go back and look at the last commodity bull market, 2001 through 2008. Well, copper went up 546%. So if copper were to go up 500%, it's a long way from $5. If you're a company that produces copper and you've got copper in the ground, you're not only getting paid for the cash flow that you generate, but you're also getting paid for what you own in the ground. So there's additional leverage in owning the companies that produce. Now, a lot of companies in the copper industry went away during this bear market, a lot of consolidation. There wasn't a lot of capital spending. And some of the companies that remain are high quality companies that have paid down debt and are generating a lot of cash at $4 and $5. So if I look at Freeport-McMoRan, copper and gold, this is a holding that we have in many, many accounts. They produce both copper and gold. About 20% of the revenue is gold. And, you know, it's moved higher about 30% with the price of copper. But let's go back and see what can happen. You know, between 2002 and 2008, copper went up 546% in the last bull market. Freeport went up 1,780%. Now, they're a strong operator and they got great assets. Not every company is going to do that. Some smaller ones more, some large ones less. But I think that's interesting to understand. That's something that can happen. That's why I care. Now, when we look at the sector, these charts I've stolen from my friends at Crescent Capital, but it looks at the aggregate capital spending in the World Metals and Mining Index since 2013. You can see that ultimately, as prices moved lower, people became resistant to spending on capital spending. What happens in a metals company is when you go through a bear market, eventually the chairman of the board puts a CEO in charge who's a CA, and their job is not to spend money and not to blow the shareholders' brains out. So over a long period of time, you don't have capital spending, you don't find a lot of new mines. Like these are the major copper discoveries by calendar year over the last number of years. Now, eventually something happens, some structural change takes place that makes people realize, oh boy, we may be on the wrong side of this. Now, I don't know about you, but I read a lot over the last few months about the massive power demand that's going to be coming on the back of AI, machine learning, and all of the data centers that are going to have to be built. We know that EV is coming. Some people think faster, some people think slower. We know the power grid in the US is woefully out of date. And we know there's a lot of money there for infrastructure spending in the infrastructure bill. By some estimates, they'll have to spend about 36% more per year over the next 4 years than they did over the last 4 years. And the one thing you need if you're going to build a power grid and put up power lines is copper. So there's a catalyst. You got more demand, less supply. Let's look at gold. Gold went through a long bear market and just recently came out 1, 2, 3 months. The last time we came to a long bear market, 3 months in, well, you weren't very far along. So gold went up 347% between 2005 and 2011. Silver recently broke out on the chart. And when we compare the performance of silver versus gold, we know that historically in bull markets for precious metals, silver stocks and silver outperforms gold. It's more levered, and that's just started happening. So let's look at a little bit of gold cycle history. The last gold cycle started around 2001. And through that period, prices moved smartly higher. It happened when we started to see falling gold production because of a lack of investment. And we knew that the gold versus the S&P 500 ratio was at historic lows. We just looked at that a moment ago. If we look at the cycle before that, started in 1973. And it was after tech stocks did remarkably well for a long period of time. Again, there was falling gold production because of lack of investment. You had a pickup in inflation, and central banks were accumulating gold. Well, as we sit right now, we do have falling gold production. Central banks have aggressively been accumulating gold. There's a lot of government debt. There's cause for concern in a 60-40 portfolio, people looking for a different type of haven. And there has been a lack of new gold discoveries. Now, if we go back and look at these dates, we had a huge run up in tech versus the S&P leading into the early 1970s. That was IBM and some companies like them. Then you had the 1990s bull market in tech that ran out of gas in 2000. And this has been the bull market we've seen recently. In other words, tech has actually become even more dominant versus the S&P, and for good reason. You know, AI is a big deal. And over a long period of time, it's going to make major changes in the economy. That being said, in these previous two times was when you started to see gold outperform. We know that there's not been a lot of new gold discoveries. We know that we're seeing falling production globally, much like we did at the beginning of the last bull market, where gold went up 500%. Or in the bull market before that, where gold went up 1,500%. Again, doesn't mean that's what's going to happen, but we have to understand the range of possibilities and watch for signs that it may be happening. We know that central banks have been big buyers, China in particular, after gold becoming a very small part of foreign countries' reserves. And we know that silver, for instance, is in a deficit versus global demand, and the estimate is for a deficit again this year. So what does that mean for the companies, right? So Agnico Eagle, which is a company we own, it's a company that's well owned and liked by institutions for the fact that it's been well managed. They've got growth. Their assets are in safe locations. It's a large cap, more conservative gold producer. It's had 3 great months recently, and the stock's up nicely. In the last bull market, it went up 1,000%. If we look at some of the smaller companies from the last bull market, Eldorado Gold Company is a big producer today, went up 8,000%. And we could go through a list of 10 large companies, all of which had moves in these kinds of percentage rates. So small part of the index. But boy, wouldn't we all like to have something that performs something like this? When we have the signs, it probably means we should have some position to start with. We always start with a small position and we start building on it as it proves itself out. Now, the question is, it doesn't go straight up. And we know these companies move around. That's why they're called cyclicals. And so I wanted to look and see during the last bull market how far the runs went before they corrected. And if we went through the period from 2001 through 2009, each of the run-ups got to 37 to 45% above the rising 200-week moving average. When things get stretched way above a moving average, ultimately there's gravity and they get pulled back toward it. They don't move straight higher. So 41%, 44%, 37%, 37%. Putting it in perspective, we sit right now about 13% above the rising 200-week moving average. And gold stocks have moved up and silver stocks have moved up. But the point is, there could be a long way to go in the near term. Now, this isn't particular just to metals companies like we think about copper and gold. This is Cameco. Cameco's been through the same bear market that the rest of the sector's been through. It went up 2,250% the last commodity bull market. When we look at Canadian natural resources and oil and gas, I've been putting these charts up on Twitter for a reason. You know, Canadian natural resources went up 1,120% in the previous bull market. You know, it's up 44% from the point where we broke out. But that may more likely be the beginning than the end. So we're seeing this across the whole sector. I think it's relevant. I also think it's relevant for the companies that supply these companies, finning equipment, for instance. You know, they're the largest Caterpillar dealer in the world. They sell through Canada, the UK, and South America. Had a 500% move during the commodity bull market of the early 2000s. It's up 36%. It's had 3 great months. There's a reason we're adding this to portfolios. All of this against a backdrop where investors like to say, well, fool me once, fool me twice, fool me 3 times, don't fool me again. I understand why there is real skepticism to look at this group. 1, because it's a small part of the index and people don't think it's relevant. 2, because it's not well loved by ESG investors. But as you can see, these can have significant moves and we don't want to ignore them. But I can tell you the broad investing population have been sellers of this strength since the beginning, which means that probably people are relatively underinvested. And while we've all worried about the tough things going on in the world and people have raced and put their money in the bond market, that's been a losing venture for 4 years. So we think that this can shift, and we think that we have to be open to the idea that these sectors can be important in the portfolio. And it's important for different markets. The Canadian market has a lot of financials, a lot of industrials, but a lot of energy and a lot of basic materials. The Canadian market tends to do well when those groups do well, and it started to perform nicely. Global markets tend to have more of those 4 sectors, and they've started to perform nicely. So a lot of evidence that we have to take into account. Okay, our job isn't to be everywhere. Our job is to identify leadership, structural changes where things can be revalued. In a bull market, these kinds of companies, not only do their cash flows grow and do their dividends grow, but investors start to be prepared to pay a higher and higher multiple of those earnings and cash flows. They start to be believed that they are more predictable. We're always looking for change, new leadership to emerge, and old leadership to recede. And there's times when there's nothing leading and we have a willingness to sit on cash. So we have a very tactical approach. We use our 3 basic tools. We use our top-down tools to identify parts of the market that are seeing expanding breadth. Where's money getting put to work? Where over time are more and more stocks participating? We want to focus on those areas. Then we want to find the best companies that we can find in those sectors, ones that are fundamentally sound and technically attractive, behaving the way they should be given what we think we know. And then the third thing is inventory management is really, really important. We have to be very good sellers and think in multiple time frames. I'm talking about very long-term pictures here, but in the short run, there will be periods where they do well and periods where things pull back, and we've got to be able to manage our positions effectively. So we do that using stop losses so we don't get emotionally vested. The top-down work is all about finding areas of improving market breadth. So what are our indicators showing right now? Well, since the beginning of May, all of our breadth models slowly turned back higher. The percent of stocks in the NYSE that are in long-term uptrends has been steadily expanding. We sit today at about 62%. Globally, the percent of stocks in uptrends is rising, and in Canada, the percent of stocks in uptrends is rising. It means it's a broadening market. When we look at the short-term indicators, percent of stocks trading above the 50-day moving average, well, in the US, it's about 70%. Percent of stocks with positive weekly price momentum or upward trajectory is sitting at about 65%. Percent of stocks making new highs versus new lows, 90%. And the percent of stocks trading above their 150-week moving average, 150-day, 30 weeks, is sitting at 70%. So 70% of stocks are trading above their long-term moving averages, most of which are rising. That means there's a lot of stocks performing well. It means it's a healthy market. It means it's not just a few companies here and there or a couple of sectors. The market's enjoying a broad-based rally. Not every sector's rallying, so we always like to take a look at that. So just quickly to touch on where we see leadership, our biggest weights have been in financial services. These are companies that tend to do well in a more inflationary world. You know, I said before, we went through 40 years where the borrower was in control during falling interest rates. Now probably control is in the hand of the lenders. So insurance companies, banks, capital markets banks performing really well, rising relative strength versus the S&P has been pretty consistent, especially in capital markets. So I talked about Goldman Sachs over the last couple of weeks. It would be unlikely that they would perform well if the expectation was a weak stock market. They make their money doing financings, mergers and acquisitions, and stock trading. Industrial companies. We think there's an industrial renaissance going on in the US as companies are taking back control of their supply chains, as we see a delinkage between Eastern economies and Western economies. And so the companies that play into this, and importantly, companies like Caterpillar or Eaton Corp, which are large holdings of ours, make up this ETF. We've seen rising relative strength in these groups. We've talked a lot about these companies. Aerospace in particular doing well for some obvious reasons, lots of big defense companies. But interestingly, small cap and mid cap industrial companies that play into the industrial renaissance are also leading. This ETF doing better than 88% of companies in the S&P over the last 52 weeks. So financials and industrials, both reflationary sectors. Concern about the impact of interest rates. Well, you've seen companies choose to destock, and now inventories from a selection of sectors are as low as they were after the financial crisis in 2009 or after the tech wreck in 2001. And we saw an uptick in manufacturing data over the last month. So it may be that these industries have skated through in very strong financial condition, and we need to see inventory rebuilding at this point, and that's really bullish. We talked about commodities. XEG, which is the ETF for Canadian energy producers, is sitting basically at 52-week highs. The XOP, which is US energy producers, performing well. XES, which is the ETF for energy service companies, performing well. Again, wanting to own the picks and shovels. These are companies that benefit by spending. To put it in perspective, this has been the bull market so far. This has been the bull market so far in red, and previous bull markets have gone on much longer. We'll see. Technology. Now, important day tomorrow. NVIDIA is going to report their earnings. It's a really important company. It is the backbone of expectations in AI. We've seen lots of technology companies report. Some have done a little better, some have done a little worse. In general, the relative price performance of the tech sector has been waning since January. But NVIDIA is performing really well. We own it. We're waiting with bated breath. We expect very, very strong numbers. We'll see how the market receives them. Microsoft has come through this very well. Broadcom is doing very well. But there's lots of companies that are doing less well. Companies reporting good numbers and going down 10 or 12% the next day. We take notice of that. We don't like to see that kind of volatility. As you know, we've been taking our position down in technology. A new sector for us over the last 8 weeks has been our weighting in utilities. We added both Southern Company and NextEra, the two biggest companies in the industry, both of them benefiting in different ways. Southern Company more focused on new nuclear, and NextEra very quickly growing in renewable energy and doing it very efficiently. We've seen a really nice pickup in investors coming into the sector. We always start with a small position that we build. We'll see, but there is expectation that there's going to be demand growth for the utility companies. They're also going to have to spend a lot of money. Things that aren't changing. Consumer discretionary. 70% of the US economy is the consumer. The XLY is an ETF made up of the biggest and most important consumer companies. Amazon being the biggest is 23%. Relative price strength for consumer has been weak. And it doesn't mean there aren't good companies. Amazon's performing really, really well. So is Costco. So is Walmart. But companies like McDonald's, companies like Lululemon, companies like Nike, companies like Starbucks having a tougher time. If there's one sector that gets hurt by higher interest rates, consumer is one. Another one is real estate, poor relative price performance, lots of difficulty in commercial real estate. Telecom hitting relative strength, new lows. And high multiple technology, less profitable technology companies seeing very weak relative strength, partly because we're paying for earnings way out in the future that may or may not come. And when you raise interest rates, you've got to discount those future earnings back to the present using the time value of money, and it means they're worth less today. Also, biotech and genomics are having a more difficult time. So there's a couple of sexy areas not performing so well, a couple of unsexy areas like energy and materials acting very well. This is a market of stocks. It's a market of sectors. We have to pick our spots. We aren't everywhere. When we look at our breadth models, if you put all of the sectors on a distribution curve based on the percentage of stocks within them that are performing well, we see on the right side sectors that have broad-based strength: utilities, insurance, builders, banks, Wall Street. Well, there's 3 financial services group in the top 7. Oil and oil service, forest products, metals, chemicals, precious metals, steel. Well, that's all materials. Transports, what else here? Transports, machinery, aerospace, industrials. So this is the strength in the market. At the other end of the spectrum, sectors that have very poor breadth and not showing any improvement: biotech, it's been declining. Gaming, that's consumer. Auto, that's consumer. Telecom and healthcare, both not sectors that do particularly well in a inflationary environment. And interestingly, software. Not many software companies performing well, although Microsoft performing very well. So it's about picking your spots. When we look at where we're positioned, this hasn't changed very much over the last number of months. These trends started emerging in March of 2023. Financials is by far our biggest weight, about double the weight of the S&P. Industrials are 12% of our total firm assets versus about 8.5% for the S&P. Energy is close to a triple weight, the S&P. Technology, many people know we've been taking our technology weight down. It's about 11%. Materials is about a 4 times weight, the index. And when we go down to the defensive sectors or the sectors that are being hurt by rates, real estate's almost non-existent in our portfolios. Consumer discretionary, very small. Utilities has come up, and we now at a market weight. And as we say, when things start to strengthen, we add. Telecom and communications generally weak. Consumer staples generally weak. Healthcare generally weak, although we do have holdings in Eli Lilly and Vertex. 2 pharmaceutical companies doing particularly well, especially on the back of the weight loss drugs for Lilly. So we look very unlike the index at this point. The last 16 months have gone particularly well. Since we started seeing this broadening, our positioning starting to work. Equal weight S&P since the middle of March 2023 is up 23.7%. TSX up 20.5%. The broad-based bond market up 1%. Our multi-asset income fund is up 27% over the same period. Our equity portfolio is up 33.8%, and our macro portfolio multi-asset is up 35%. Year to date, equal weight S&P is up 6.9%, TSX up 8.4%. The income portfolio is up 13%, equity portfolio up 14%, and the macro portfolio up 15%. And in our new global fund, which we launched in December on the back of new global strength that we were seeing, the index is up about 11.5%, where our fund is up about 14.3%. So we're pretty happy with how things are going. Now, we watch for signs of risk. We watch credit markets. We can see that credit markets, the spread that investors are demanding to get paid over a government bond has been narrowing, meaning people don't see particularly high risks in corporate credit. When we look at volatility, volatility has fallen to a level that really only exists during cyclical bull markets and stocks. No sign of problems here at this point. Not to say these things can't change, but the net of it is we think we're in a structural bull market in equities. We think there's a real opportunity in materials and energy. We watch for signs of change. We're very willing to get defensive. But at this point, we continue to be pretty bullish. And with that, Pamela, if there's any questions, certainly we can take a crack at them.
Thanks so much, David. Well, you did a great job with this review. I think our viewers are still maybe on their long weekend. We have not received any Q&A today, or rather questions in chat. So I will leave you, as always, with the final word. Oh, Dave, I spoke too soon. Here's someone coming, asking David, just wondering if you hold any of the rails.
So the rails have been tricky recently. So we've seen a pullback in the transports, and the rails are part of that. We had a position in CP, which I believe went out last week or the week before. It's a group that I'm watching closely. If you look at the IYT ETF, see if I can share it with you here. No, it's not coming up. I apologize. Zoom, where are you? My controls are missing. Well, you have to trust me on this. So as of February, relative price performance for the IYT was better than 80% of companies in the S&P. We're sitting today at 45%. The IYT has traded down through the 150-day moving average. So it's now trading below all of the major moving averages, in and around the 200-day moving average. And so we are less bullish here now. You would expect for the rails to do better if we're going to see a pickup in bulk shipping. But at this point, the group is having difficulty. So we'll have to wait and see.
Dave, here's another question from one of our viewers. John asks, copper pulled back today. Any thoughts as to buying opportunities?
Look, these things are gonna move around. Copper's had a nice move higher over the last 3 months. My guess is that the gains are going to be much stickier than people have been used to over the last few years. When you ultimately make an exit from a bear market, we're all used to big drawdowns when they pull back. My guess is we're going to see these gains much stickier over the next while. So certainly, the stocks can pull back a little bit. If we're looking out over the next year, my guess is we're seeing them a lot higher. So companies like Ivanhoe or Hudbay in Canada, companies like Capstone Copper, Foran Mining, the smaller guys, all of them, potentially are targets. We know that BHP recently came after Anglo American. They're looking at Anglo because they have strong copper assets. So we think that there is going to be some mergers and acquisitions. We know that Teck was a target. Teck Resources was a target a year ago. At the beginning of a bull market, as they often say, copper's cheaper on Wall Street than it is finding it in the ground. And so we may see some deals along the way. So I wouldn't try and be too cute. My guess is we'll see little pullbacks here and there. But right now, the breadth models are all positive, and the price action is very good.
Dave, here's another question for you from Gerald. He wants to know if you consider Uber and Lyft transportation.
Well, they are considered transportation, even though you would say Uber is probably a consumer stock. Just like Amazon seen as a consumer stock, is probably a technology company. So Uber is pulling back. It recent high was $82. $64 here. It's trading about 3-4% above a rising 200-week moving average. It pulls back regularly to the 200-day moving average. We got extended above the moving averages in the beginning of January 23. We pulled back to the 200-day. We got extended above the moving averages in July of 23. We pulled back to the 200-day. We're pulling back to it again. These companies are a little more volatile. We'll have to expect to see that happen.
Great. Thanks so much, David. That concludes the questions that we've received so far. So with that, I'll leave you with the final word as always.
Well, listen, we appreciate you sharing a Tuesday afternoon with us late in May. The weather's getting nice. I know people are going to the golf course. I know there's always concerns about May, June, July. All I can say is that the breadth models that we follow have only been strengthening over the last few weeks. We'll watch for any signs of deterioration. But we do know, again, knowing what can happen, if you look at took every year where an incumbent was up for re-election since 1950, a market actually stayed strong through the summer, April through the end of the year. So maybe that's the case this year. Certainly we're seeing some inflection in some economic data. So we'll keep an eye on that. But we'll keep doing these every Tuesday. If you've got questions that we're not answering, please send them in to us. If you're too shy, pick up the phone. I'm happy to have a conversation one-on-one. We've had lots of new folks that have been calling us over the last few months, and we're in the business of growing the company, and we love to have new clients. So always happy to talk. Pamela, thanks very much for moderating today, and we'll see everybody next Tuesday.